CNBC-TV18, and we have a very special conversation lined up now. We have Prashant, Khemka, founder of Whiteoak Capital Management, joining us to discuss the moves that we've seen in the market and where things could really be headed from here on, as well as maybe how you would play this theme. Mr. Khemka, thanks a lot for joining us today on this day, which is, so big for us. We are celebrating 25 years. So first off, thank you for joining us, not just today, but, being a part of this journey, which has spanned so many days. And that said, I do want to ask you about, where you see the Indian markets headed from here. Everyone's been talking about the fact that this is India's time, this is India's decade. But where do you find the opportunities today?
Certainly. Thanks for having me here on the show on this very special day. And I was just listening to Shireen a few minutes ago talk about the 25-year journey. So let me take a minute and add a few words to that. As Shri was talking, I was reflecting back the first time I saw CNBC in India. So I used to live in the US in the late 90s and the early 2000s. So one of those trips when I would come here every December, winter holidays and sometimes summer holidays. So when I first saw CNBC on the TV, I was so excited because in US, you obviously have had this genre for many years. And very true, you created this genre and it has played a very important role in attracting, say, millions of investors, retail investors. That's been the best part. They've gotten attracted to the market by after watching, you all on the TV, and they've had their own fantastic journeys over the last decade, 2 decades, 25 years, and so on. Whenever they started, watching. So kudos to you all, and thanks for having us also participate in that journey through these interactions, and wish you the very best and wish you that you break all the viewership records in the coming years as the markets continue to break the records. All right. So coming to then as a segue to your question, yes, the outlook for the market is very solid at this time, very optimistic. The markets have risen over the last couple of years, and global investors do point out that Indian markets have done much better than other emerging markets or even developed markets. But when you look at in context of the earnings growth that Indian markets have delivered over the last 3 years, so the pandemic year, the fiscal year 21, was supposed to be initially a horrible year for earnings, but ended up being very positive year in itself and acted as a catalyst. Since then, the earnings trajectory has moved up to 20% CAGR over the last 3 years. Prior 12 years, we had about 5% earnings growth. Last 3 years, about 20% earnings growth, and projections are for mid-teens earnings growth going forward, which is amongst the very highest globally. So while the markets have trended higher, the P multiple actually has not gone higher. In fact, it is somewhat lower than what it has been on average over the last 10 years. Though relative to other markets, it might have become more of a premium because other markets like China, led by China, I would say, has done, China has done very poorly, and other markets led by it have done poorly as well. But those are for separate reasons. For India, I do see very strong interest in amongst investors globally, and the political uncertainty, which is right now of primary concern, or I would say is the primary factor that's been holding them back. I think with the events of the last weekend, many are overcoming that as well and not waiting till May.
Prashant, thank you very much for being a part of our journey, providing that wisdom every time you come on the channel and help build this entire cult of equity market investing. Do you remember the first time when you came on the channel? What was your experience like?
That's a very good question. I would get it wrong. I think the first material meaning significant time period, would be the Asian Tiger Show with Udyan Mukherjee.
Okay.
But because this is only in 2017, whereas I've probably been appearing since much earlier. Sorry, my memory is bad, so would take that back.
All right. Okay, so let's get back to the markets. You said that the outlook for the market is very solid, but then there are those pessimists, the naysayers in the camp who believe that the markets have priced in all the good things. The political certainty, the fact that we're going to get a very strong mandate once the election results come out in the middle of 2024, the earnings growth, the macro stability. So what can positively surprise to provide that return, extra return? In fact, the only surprise can be negative because you're anyway expecting all good things. How would you respond to that?
I would say, look, that's why I use the word solid. I've never been one to necessarily pound the table that over the next 1 year, market's going to give some heroic returns. I think low double-digit returns are reasonable expectations. That's what the market has provided over the last 20, 30 years. And that's very good return in today's day and age. If you can get low double-digit returns for where the inflation is, where the interest rates are, and where the tax rates are, 10, 11% from the market is very solid return, and that's what I meant. And that's compared to the projected earnings growth, it's somewhat lower. So I do expect that market is expecting a mid to high teens earnings growth, and as we move forward, maybe it'll slip a little bit on the multiple, but that's there's nothing wrong with it, and low double-digit return itself is very good from the market.
Okay, got that. Mr. Khemka, I want to ask you one question on the Fintex. Ever since the RBI tightened norms on unsecured consumer lending, take us through how you look at it now. I mean, you have one of the big fintech companies yesterday saying that they want to cut down on the low ticket size loans. But as soon as you move into the higher ticket sizes, there are the banks, there are the NBFCs. So how do you look at this entire pocket now?
So without talking necessarily about any particular name, and our team has always had very sizable exposure to financial sector, but most, if not all of that, at least amongst the lenders, is to lenders with very strong balance sheet. Some of the private sector giants who have very strong liability franchise. And so on. I think if you just step back and think of the RBI action, I think people have focused a lot more on the negative hit on the capital adequacy ratios, or the negative hit on the cost of funds for some of these NBFCs who are more exposed to that retail segment. But I think on the positive side, what people I've not heard talk so much about, this is something that reduces the risk in the system. That was one of the risks we as investors and a lot of other investors were worried about, and would constantly ask managements about how they're addressing, how they're handling this potential risk that is building up. So RBI has taken a proactive step, and I think it definitely reduces the NIMs by a very small marginal amount. I think when you combine that by the risk reduction in the system, it is not necessarily a negative. It's much more sound system, hopefully, due to such actions from RBI.
Thank you, Prashant, for joining in, and hope you're a part of our journey as we get set to embark on the next 25 years. Thank you very much, sir, for joining in. We will slip into a very short break on that note. We'll come back and we'll talk commodities. Manisha Gupta will join in.